Hey everyone, welcome to the channel. In this video, we'll be covering the bank reconciliation statement. We'll be breaking it down step by step so it's easy for you to understand it. Let's get started. What is a bank reconciliation statement? A bank reconciliation statement is is a document that basically compares the balance, right? The balance in the business's cash books, right? And the balance on the bank statement. So that's basically what a bank reconciliation statement is. So it is when now a company has has made sales and has bought stuff, but now since their books, it's mostly cash, so to say. We know that there was also EFT transactions and all that, but remember that the money that they have is going to be different from their bank statement. So they need to make sure that when they're doing a bank reconciliation statement, they make sure that the balances of the two statements are actually balanced, because those are two different statements that work together so that so that the business can see uh, on what amount they have at the end of the month or at the end of the year. Right. Then now, what is the purpose? The purpose is to identify and explain differences so that both records reflect the same final balance. So as I said, is that at the end of it all, we want to make sure that the two statements, which is the business's cash book and its bank statement, literally say the same thing. Right. Now, why do the differences in the business's cash book and the bank statement, why do they have differences in them? Right. First one is unpresented checks. Right. So now with unpresented checks, that one is checks that are issued by the business but not yet. My bad here. I was supposed to write yet. So here it is yet. So it is unpresented checks are checks issued by the business but not yet cashed. So in other words, um, a, a business would literally pay using a check, but now that check has not been cashed. So meaning that it was not given to the bank so that they can give them money. So that's how the differences would occur, is that that transaction will be there in the cash's book, but it won't be in the bank statement, because why? It has not been cashed out yet. Then now, second one, it's deposits not yet reflected, right? The deposits are not yet reflected. So this one, it is cash received but not recorded by the bank. So remember, when uh companies make money, when they take that money and go and put it in the bank, like physically they go take the cash and they give it to the bank so that they can literally put it into their bank account. What happens is that that transaction is recorded in the business's account in the cash books, but it's not yet recorded by the bank. So that's when now the difference is going to occur, because that transaction has already been done in the business's cash books, but the bank has not yet recorded it on their side. Third one. The third one that we have is what we call bank charges. I'm sure everybody now is familiar with this word, bank charges. Obviously, everybody has a bank account at this point. I'm guessing, this is just me guessing, that you have a bank account. So when you have a bank account, there's something that banks do, which is they charge people for using their their bank actually. Yeah. So they charge people for using their bank. So as you can see here, bank charges are deducted by the bank, and they are not yet recorded in the cash book. So this one, it happens when now you have a bank account as a company, and the bank literally decide that, you know what, for bank charges this month we're going to charge them 100 rands. So for that 100 rands, it is charged by the bank, but us as the company, or them as the company, they basically don't know how much the bank charge is, so they have not yet recorded it, but it has been recorded in the what, in the bank statement. So that's where the difference occur now when it comes to the bank charge. Now, fourth one that we have right there is what we call interest received. So this one, it is added by the bank and it is not yet in the books. So in simple terms, what he's saying is that same way you would have your bank charge you'd also have something we call an interest received, right? So with an interest received, it's that when you using a bank account sometimes, some banks offer that if you have your money in your bank account for the whole year, it's going to gain a percentage of 2%. That 2% is literally the interest that is received because they're giving you money. So you can see, obviously, you can already tell that that amount of that interest will be stated by the bank. So meaning it's going to be there in your bank account, in your bank statement, my bad, in your bank statement, but it won't yet be in your business's cash books because you have not yet known how much the interest received is amount, like what the amount of the interest received is going to be. Right. Then obviously, in simple terms, basically the reason why there are differences is because there might be errors in the cash book or the bank statement. On this one, it's when now you haven't recorded an invoice, you have not recorded a check, you haven't recorded an EFT transaction. So that is why differences would occur, whereby there would be missing transactions in either the business's cash book or the bank statement. All right. So now, these are the concepts unique to the bank reconciliation. Remember, I don't want us to just now head into the bank reconciliation without even knowing what types of adjustments you're going to be looking at and how do they actually affect your business's cash book or how it affects the bank statement. So let's look into it. The first one, we have the current bank account, right? So a current bank account is an account from which money can be drawn immediately without notice, right? And payments can be made by check, electronic transfers, or debit card. So now, in simple, to make it simpler for you, is that think of a current bank account as your bank account, your Capitec bank account, your FNB, Standard Bank, ABSA, any that you can think of, your current bank account. Have ever realized that when you would pay something, the money leaves your account immediately? When you send the money out of your account, the money leaves your account immediately. When you receive money, it comes in your account immediately. You don't have to wait 2 weeks for the money to actually come into your account. I know there are transactions that take 24 hours, especially when you're transferring from one bank to the other. But obviously, the moment you send that money, it leaves your bank account. So obviously, it is drawn immediately without notice. So that's how you would remember a current bank account. Second concept you need to know are bank charges. I've explained this one is that they are deducted by the bank, right? Because these are what amounts deducted by the bank as payments for the services it provides. Like I said, the bank literally charges you for using their bank, right? So that's what bank charges are. Then now we have something we call a bank overdraft. So now let me explain this quickly. A bank overdraft now is when the business has withdrawn more money than what was deposited in the bank account. Let me explain that. So if a let me just say you deposit 10,000 rands in your bank account, or you have 10,000 rand in your bank account, but now there's an emergency that happens, whereby now you know what you say, you know what, instead of me taking out the whole 10,000, I want to take out more. I want to take out 15,000 rands out of my bank account. And somebody might be asking, but how is it possible that I have 10,000 in my bank account, but I want to withdraw 15,000? That right there is what we call a bank overdraft. So it's an agreement that both a company or a business and the bank had, that in this account, you are allowed to withdraw 5,000 more. You are allowed to withdraw 10,000 more. It could be higher, it could be a million more, depending on the type of company or the type of agreement that you have made with the bank, right? So that is actually possible, right? I know you can do it if you're to have like 100 rands in your bank account and now you want to withdraw 200 rands. It literally doesn't work that way. You need to have an agreement with the bank account that, with the bank, that in case of you getting a bank overdraft, you can literally withdraw 5,000 more or 10,000 more, right? So in simple terms, that is just the bank overdraft. It is when you withdraw more than what you have in your account. I hope that part right there is understandable. Then now let's go to the next one. The next one there we have interest on overdraft. So this one, it represents a payment or an expense to the bank for an overdraft bank balance, right? So this one is basically it's the interest that they charge you for taking that extra money, basically. Take it a little bit as a loan, but I don't want to say it's a loan because it's like it's a short-term one, basically, right? Because you have to pay back that money. So that extra 5,000 that you take out, you need to pay it back. It's not yours, basically. So they're gonna charge you interest on that overdraft. So that's basically what interest on overdraft is. Then now we have interest on current account. So this one is a receipt or an income from the bank for reflecting a favorable bank balance. So this one is just the interest that you get for just having money in your account. Remember, I said that sometimes banks literally just say that, okay, since you're using our bank account, we're gonna give you 5% interest each and every year. Then that is when now that interest on current account comes in place, right? Then now we have a credit card. So a credit card, this is used to buy goods or services from suppliers and the amount is paid back to the bank later. So a credit card is basically a card that you get, but now the difference with this one is that now you will use it to buy from suppliers. You'd buy stuff from suppliers with that card, but now that money you're going to pay it back um, later on back to the bank. Right? Remember that businesses sometimes they do buy on credit. So when you buy on credit, you need to pay back that money. So that's basically what a credit card is. It's basically you paying now, you taking stuff now, but you're gonna pay it back later, right? Then a debit card is basically just the cards that you use on a daily because when you're literally buying or you're paying stuff, the amount is literally deducted from your bank account balance immediately, right? It is taken out immediately. Then the last one that we have right there, it is the deposit slip. So the deposit slip, this form is used to record the total cash and checks received for the day and is proof of the amount deposited in the current account. So basically, this one it's basically, remember that sometimes in a business they would buy using cash. So when they buy using cash and checks, at the end of the day or at the end of the month, the business is going to go to the bank and be like, okay, since now I have this cash and I want to put this cash into my bank account, I want to deposit it. When you deposit it into a bank account, the bank is going to give you a deposit slip saying that, oh yes, we did take your cash and we are going to put it in your bank account, basically. So that's what a deposit slip is. Then, oh, last one, the electronic funds transfer, which is an EFT. Everybody should be familiar with EFT right now because it's basically an electronic transfer of money from one bank account to another without direct interaction of the bank staff. So this one is basically when you literally sending money to your friend, when a company is just sending money to another company or another business or whatsoever, they literally just use EFT because that money you don't have to go to the bank then after going to the bank, you take the money, then go give it to the person. Or you go tell the bank, or wait, can you pay this person this type of amount? You can basically just do it through your phone, your laptop, tablet, any, right? So that's just what an EFT is, but everybody should be familiar with it. So yeah, that was the last one right there. All right. So that's it for today's lesson. Right. So if you definitely found this helpful, make sure that you like, subscribe, and don't forget to drop a comment with any question or topic that you want me to cover next. But next up, I want us to actually look at how we would deal with the bank reconciliation statement if we were to be given one in an exam. And with that said, thanks for watching, and I'll see you in the next one.